Yeah. Surprise, a little different than you used to. Dropping these bars on YouTube, knowledge I introduced you. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck.
All right, what's going on? Welcome. We have a lot to talk about today. I've been crunching some numbers this afternoon, and if I'm honest, I want to be very, very careful with the way I position this, because I do not want this to be to come across as negative or defeatist. That is not the goal here. But I do think that it's important to understand the scale of the challenge in front of us, or in front of you if you're a first-time buyer right now. The numbers aren't great. Doesn't mean it's impossible, but it means that you need to be more purposeful. And I'll provide some thoughts and some maybe some tips all the way through this to hopefully help you. But I do have a poll. I have a question in the chat section here. I'm asking you, how far do you think property prices need to fall to balance out the interest rate hikes that we've seen? Now, today we have seen news that Halifax and a number of the major lenders are going to be reducing rates, and they have been reducing rates all the way through last week. Why? Because there is no longer this fear that interest rates are going to peak at 6%. We've covered this on the channel prior. It's now going to be about 5.75% is what is factored in. So all of the rates that they initially had put into their mortgages in terms of the increases that they delivered, it was accounting for the fact that we probably get to the 6% mark, which is no longer the case. So that's a little bit of context right here. What I've been doing this afternoon is trying to work out, right, so based on the average 2-year fixed rate, maybe from 2021, right? So the low rates that we've come from to where we are right now. So the average 2-year fixed rate at the moment, according to, and this will be a great time for me to bring in the first article that I want to reference here, is now 5.39%. So this is an article on the BBC right now. The UK's biggest mortgage lender will reduce rates by up to 0.71%. That's Halifax that they're referencing there, from Friday this week, with a 5-year fixed deal priced at 5.39%. Okay, and that's going to be down from 6.1. So quite a big reduction in the mortgage rate. Now, that is obviously really, really good news for first-time buyers, no doubt. For mortgage holders, period. It's a really, really, really good piece of news to kind of face and be able to contend with. But the reality is these rates are still much, much higher than when they were back in 2020, 2021. And I've been saying that we have seen the end of low interest rates. They're just not coming back. I feel as though this is probably where we're going to land in terms of the rates for 5% roughly. Now, with that being said, the question that I often get, and I guess the question that a lot of first-time buyers will have is, right, so interest rates are going up. You're waiting for property prices to fall. And the question is that likely to happen? Now, we don't know. I don't know. I don't have a crystal ball. Nobody knows. But what I have done this afternoon is crunch the numbers to see, right, if we take what were low interest rates before, what we knew they were before, to what they are now, what's the difference in the mortgage payment? So what's the reality, right? Back then, your mortgage payment would have been X. Now it's going to be this. Is there any way that you can bridge the gap? But more importantly, how much of an adjustment would we need to see for the mortgage payments to be akin to the lower interest rate environment? I hope that makes sense. Tell me if it doesn't in the chat, okay? But hopefully that does make sense. And we're going to look through the numbers and see where we are. And then we're just going to dissect the reality of it all, really, to be honest. And again, I don't want this to be a negative thing, but I do think it's really important to kind of understand the size of the challenge that is ahead of most people. Now, the other thing that I do just want to share with you here is the news today that we are seeing property prices fall at a pretty decent rate. Now, this article is referencing the Southeast. We've seen the biggest drop in the southeast by about 15,500 pounds over a year. So this is July to July or June to June they're referencing here, right? Now, this is the interesting piece of data. So Halifax, the high street lender, said the average house price in that area, which includes home counties, fell by 3.9%. Now, it's interesting what they reference here in terms of the average value of the typical house. The value of a typical house in the UK is about £285,044. Now, if I go onto this site right here, which is actually the land registry, it says here as of May 2023, the average house price in the UK is £285,861, and the index stands at 149.9. So there isn't too much of a disparity between the two figures that are being reported here in this article and what we're actually seeing from the land registry in terms of the average UK house price. Now, really, really important, because I am going to be using this number in my comparisons in this conversation about, what's the reality for first-time buyers. And when I crunched the numbers, I was like, wow, because I honestly don't think that we're going to see a shift in property prices to the extent that would be needed for us to find some kind of equilibrium to where we were before. I just don't think it's going to happen. And I'll talk about why and why this is so important for first-time buyers a bit later on. All right, so remember this number, £285,861. That right there is the number. Now, the first thing I want to do is basically just go back over time and, let's just reminisce a little bit, right? Back in 2021, the average, and bearing in mind, this is a 2-year fix here that I'm using here. I'm going to be using a 5-year fix to bring it up because of the rate difference and stuff. But the average 2-year fix was 2.34%. That was the average 2-year fix rate in 2021. Now, the average home price is £285,000. I'm assuming that you have a 10% deposit going into this to get your 90% loan to value, at least try and get some kind of a decent rate, better than a 95% loan to value, because then you're looking at the bank's risk factoring and so on and so forth. So your mortgage amount with a 10% deposit will be £256,500. Now, I've gone with a 35-year term, and we can play around with this number, and let me know if you want me to in the chat. But 35 years is the term that we're going for. The maximum term is normally 40 years, but at 40 years, they're going to start asking you whether you've got pension provisions and so on and so forth. It might be something you don't want to do. So 35-year term. And this is a full repayment mortgage. We can have a look at interest only in a moment. And this is on Money Supermarket, so good old Martin Lewis. So this is what the payments are. So you're going to see that your monthly payments back then, if you got a mortgage, 10% deposit, property value, £285,000 over a 35-year period with the average 2-year fixed rate at 2.34, £896 per month is what you would have been paying under the old regime of low interest rates. That's what it would have been. So remember this number, £896. Now I want to go onto this current picture. So this is where we are right now. So this is looking at the same scenario. So £256,500, £500, 35-year term. So you still got your 10% deposit, but we're now looking at the 5.39%, which is what Halifax will have available this year. This is on a 5-year fix, so slightly different in term, 2 versus 5. Full repayment, but look at this. You're looking at £1,360 for that same mortgage. And the difference that you're seeing between this one right here and this one right here is down to interest rates. And so this is where I guess a lot of first-time buyers have issues in terms of, yeah, we may be seeing property prices fall 3.9% in certain areas, but that doesn't help you because interest rate means that you're paying more anyway, even though the price of the property has fallen. And so it can feel as though you're fighting a unwinnable battle, really, to be honest, because you now have all of these factors conspiring against you, principal of which is interest rates. Incredibly frustrating. I can completely get that. Now, here's the big question that I try to work out this afternoon, looking at this. If it is true that we are going to have a property correction, house market correction, how much does the property price correction need to be in order for us to get back into some area where this is your mortgage payment? How far does it have to fall? How far does it have to fall? So again, bearing in mind that the average house price is £285,000. I just want to check the comments and see whether you guys have put your opinions in here, because I would love to know. Can you guys see the poll actually, by the way? But there is a question here from Rahman. I'll come back to that in a moment. No one's put anything in here at the minute, but I'd love to hear your thoughts before I actually do the reveal. Put it in the chat for me. How much do you think the average property price would need to fall to for you to get back to £896 per month, same mortgage payment as it would have been based on the average 2-year fixed rate mortgage of 2021? Let me know in the comments. I'll wait very, very quickly. And bearing in mind, average house price at the moment in the UK, £285,000. Now, obviously, these numbers will adjust. And again, you have to do your own research on this, because using Land Registry, those numbers are still lagging. So we won't know what the current ones are as of, well, this is saying it's May. So it's a little bit behind. But let me know, what do you think it needs to fall by in the chat? Now, I'm looking at this. Let me just share this next one for you, because this will be surprising. And it's quite a big drop. 25% Bishy's saying here. I think someone said here 20%. Okay, so let's have a look at 25%, £285,000. Let's just do it simple there. Times 25%. So you're saying about £71,000 you would need to have in terms of the property correction to come close to the same mortgage payment. These are the numbers that you would need to see, and this is how much property prices would need to fall to be at the same payment. Now, forget a 10% deposit at this point. I'm just looking at the value of the house that you would have to buy. You would have to see a fall to just under £170,000 to come to the same monthly payment based on a 5.36% rate at the minute, which will be available on Halifax. Now, I know someone's just asked in here, interest only. Let's have a look at interest only. Actually, let's do this live. Let's actually have a look at this live. So let me just go back to this one right here. This one on interest only. And obviously with interest only, there are lots and lots and lots of caveats and things that you need to be mindful of. So on interest only, £285,000 property, 10% deposit, 35-year term on what was the old 2.34 average 2-year fixed rate mortgage, your payments would be £501 per month. Let's have a look at the current rates at the moment. And again, this is using the average, the 5-year fixed rate of 5.39, right? Let's recalculate this very quickly. £1,153. So about 600 quid difference, roughly, right? Interest only. Now, this one might be a little bit more difficult to pronounce. Well, let's have a look and let's see what it does. Let's see what it does. 758 quid. So it's even on interest only. You are actually, you can't see this. Bear me 1 second. So this is the new region. So even if property were to fall, right? You saw a property crash. Property values got down to £169,000 roughly, just under £170,000 on an interest only. You'll still be paying 578 quid, which means that this number would have to fall even further on an interest only mortgage. Actually, well, you're low. Actually, sorry, no, you're lower. So you're lower than that. So you could afford probably around about the 170,000. But the danger with an interest only mortgage is it is interest only. And what then happens is you're going to have the capital for the 169,000 or whatever the sale price of that property was. You're going to have to cough that up at the end of your mortgage term, which is why interest only is such a tricky place to be. It can be used and is used by people who may have, for example, investment properties where they don't really have any intention of holding onto the properties. Yes, they'll use it as cash flow, rental income, so on and so forth. But the ultimate goal is to liquidate that property portfolio at some point in the future. And they'll happily take the hit on the capital gains tax, right? For residential properties, though, it is problematic. And I've seen so many people over the course of my career where it's a surprise that they're on an interest-only mortgage because they just didn't understand, or it wasn't explained clearly enough, that an interest-only mortgage only pays the interest on the mortgage. That's all it does. It doesn't pay down the capital. And so we've spoken about how interest only can be used to give you a little bit of respite, to give you a little bit of headroom so you can reorganize your finances if you're struggling right now. But it's a really, really dangerous option if you don't opt to go back into a full repayment mortgage at some point in the future. I always said to people when I was advising as mortgages, your starting point needs to be a full repayment mortgage. If it's not, then the question is, can you really afford it? But going back to what we're talking about here, the prognosis isn't that great for first-time buyers because I cannot see a world where currently, and let me know if you're watching live in a chat or maybe you're watching a rerun of this, let me know in the comments. Do you really see the average home in the UK, the value of the average home falling from 285,000 to just under 170,000 pounds? That's a 110,000 pound hit that you would need to have. And so in trying to tie this all up and speaking directly to first-time buyers, a lot of people are asking me, should I wait? Should I hold fire? Should I see what happens with the property market? And I've been saying to people, look, you need to pay attention to your local area and speak to, your estate agents there and just keep your ear to the ground. Because look, it isn't impossible. Stranger things have happened. 2007, 2008 happened, and no one ever thought that was going to happen. It might happen. But I think the likelihood of us seeing the average property price in the UK fall by £110,000 is so slim that if you wait and wait and wait and wait and wait, you potentially get yourself into a situation where there may have been a deal, an opportunity for you to get into a house, a property that, okay, may have been a little bit of stretch, but it's still affordable for you. Whilst, the prices are down, in opposed to waiting and then property prices go up. It's a really, really tricky situation to be in. And I think within all of this, even listening to me on YouTube, you need to do what you feel is right for you, and you need to do your thorough research to kind of be able to make an informed decision. So you're not second guessing yourself, and clarity on this is going to be very, very important. Interest rates as they currently are, I think they're going to be here to stay for some time now. And so that adjustment, we've spoken about it so much over the past 2-3 weeks. That adjustment, we have to be prepared for that adjustment. You have to be prepared for that adjustment. And that may mean, as I've been saying, if it takes longer for you to get on the property ladder, yes, I know it's a double-edged sword. You wait, property prices go up, you can't legislate for that, and that means your deposit needs to be larger. Keep your ear to the floor in your local area and really be proactive is what I'm going to say here. There were lots of comments on here, so let me just get into what you guys are saying in the chat. And maybe take some of your views as well. How you doing, Leo? Welcome. Thank you for being here. Bubble Bacon Bunny. What a name. Surprised. A little different than you'd used to. Dropping these bars on YouTube. That's right. I love it. Thanks for that. That's made my day. Cheers. All right. Someone's saying here, Naeem. Let's see what Naeem's saying. Hi, Pete. Been a while since I've been on live with you. How is everything? Anything to look out for in the financial news? Thanks for reading. Right now, it's all been about interest rates and mortgage rates and the impact that is having on, obviously, homeowners and renters. I've not really done any investment content for a while. Actually, well, I say that I have done a couple of investment videos and stuff, but I've had a ton of questions about what do we do in this instance. So it's kind of been focused mainly on here. Look, interest rates and inflation are an interesting conversation right now. I think that's been the big conversation piece for a lot of people, and that's kind of where my attention's been. Someone's asking it, is this for a remortgage? No, I mean, this will be it won't be applicable for a remortgage specifically because you're already on the property ladder. This is really speaking to first-time buyers. But with that being said, if you do have a mortgage right now and you're remortgaging, the fact that the mortgage rates have started to fall over the past week and a half, it's going to serve you good. And this actually brings me on to even maybe a sidebar, actually, and I use myself as an example here. So as you know, I've gone from, or will be going from, a 1.49% fixed rate into a 4.75% fixed rate come the end of October. So November the 1st, my new rate is going to kick in. Now, I've been talking about the fact that you have 6 months to shop around for your new mortgage deal when you know that your mortgage is going to be coming to an end. You've got that leeway. If you agree to go on to a particular rate, so I've agreed to go on to a 4.75. Now, let's just say, mortgage rates continue to fall with Halifax now for the next 3 months or so. And by the time I get round to my mortgage being renewed on November 1st, midway through October, I can phone them and say, look, I want to know what your best 2-year fixed rate is that you have available right now. You've offered me a 4.75. Is there anything better? If they have something better, I will switch to that better rate. And so I think it's really important that even if you do have a mortgage and you're looking to remortgage right now, paying attention to what's going on is crucial, because you may be fixed into, imagine, right? You've fixed into a 5-year at 6%. Today's good news for you, because now you can go, actually, hang on a second, the rate's gone from 6 or whatever it is that you offered me on a remortgage to a 5.31. Can I get on that, please? And as long as obviously you meet the criteria, because obviously a lot of them will be tied into loan to value, how much you have outstanding against your mortgage versus the value of your house. As long as you're within that bracket, you should be fine to get onto the 5.31%. So paying attention to the news right now is going to be really, really important. And obviously, I'll do my bit to try and keep people updated, let you guys know what's going on in terms of rates and what I'm finding, what I'm hearing, speaking to people. But yeah, this is mainly for first-time buyers, but there are lessons for people who are already on the property ladder who maybe want to remortgage as well, because a cut or reduction in the mortgage rate is always good for everyone. Are new mortgage rates always above the Bank of England base rate? Can you ever get any lower mortgage rates than the bank rate? Let's say if you had a 50% loan to value and great income, credit score. Typically, it depends really. I mean, sometimes you can get onto. It's a shame I didn't show the slide last week. I was looking at the loan to value thresholds for one of the lenders, and they actually showed you how it kind of decreased. But typically speaking, once you get to like 50% loan to value, they don't really drop that much beyond that, to be honest. But you'll still get a pretty decent rate. But the limits tend to be 50%. But in answering your question, can you see them lower than the Bank of England base rate? I mean, yeah. I mean, the Bank of England base rate at the moment is 5.25. I'm going to be going into a 4.75. But my loan to value is 42%, roughly. So I'm at that lower threshold to get that 4.75% interest rate. So it can be. But yeah, it's all down to the lender to decide. Aaron's just saying here, land registry data will show us how much house prices have really dropped, but there's going to be a time lag. Yeah, there is. So that data there was from March. We don't know what's happening in June, from May, sorry. We don't know what's happening in June, July. We don't know. There's 2 months behind at the moment. So it will be interesting to see what happens once all of the data catches up, to see how far property prices fall. Well, the average property price falls from £285,000. And maybe I'll just do an update to this video, because it will be a nice reference point for us to check. How much did it drop in June? How much did it drop in July? And looking at it towards the end of the year, if we go back to, this video, and we have data running up to hopefully maybe October, to see what the difference is. Like I said, it's not impossible that we see the average house price for £110,000, but it's highly improbable as well. But You never know what's going to happen. Never know what's going to happen. Yeah, someone saying you're not far off there, Judy. Average 250, average is 285 at the moment. Well, as of May, I should say, because the data is a little bit behind. So someone's saying here, Aaron's saying here, so really house prices dropping only really benefits those who are cash buyers or those with larger deposits. Exactly. If you're a cash buyer, yes, you've got the incentive, right? You've got the initiative behind you because you can exchange quick, you can close it down. There's no chain. If you have a large deposit, is going to help you access a better rate, which I know it's counterintuitive to say, look, try and work towards a large deposit because in the meantime, house prices might be going up. But really, the more deposit you have, the better the rate you're going to get, the lower your payments are actually going to be in the long run. And just as a reminder, guys, before I do forget, let me just end this Q&A on here, actually. 1 second. End that Q&A right there. Confirm that. If you have got value from this, by the way, do me a huge favor and make sure you just tap the like button. It takes a second for you to do that, but it means that after this live is concluded, the YouTube algorithm will push this to other, first-time buyers or people who have mortgages who may be interested to know what we've spoken about here. It takes a second to do so, but it really does. It makes a massive difference to the channel in terms of our growth ability and so on and so forth. And I just want to say as well, look, we crossed 42,100. I think it was like yesterday or so. So we're really growing at a really nice rate. We're fast moving towards 42,200. So if you haven't subscribed already, please consider subscribing. That will be amazing. Bernard is saying here the best way to source housing information to source a house, just looking at places like Rightmove. I think you were going to say there. Yep, absolutely. Good question, Anil. Do we need to accept that we're getting poorer? You know what? I think is relative. I think as a nation, if you looked at the overarching picture and you looked at the entire population or not just little bubbles of it, I think so, 100%. But even in times like this, there are people who are doing extremely well. I mean, I'm lucky that I do relatively well anyway. And it just so happens that I work in an environment that what I do is relevant, right? And so, I mean, to be honest, I've been extremely lucky since 2020. I started at the right time here on YouTube, and I've been a beneficiary of people wanting information and needing information. Hopefully that continues for a long time. But I think as a country, for sure, we are definitely getting poorer, but there'll be pockets of people who are still doing extremely well. I mean, I was doing a talk about 3.5 weeks ago, and someone was telling me about, creators make a lot of money. I mean, on TikTok, it's mad. I mean, young people as well, raking it in. The issue that I then have is, and the question I ask is, are you using it wisely, or are you just being frivolous with it? Because people assume that once you're doing well, it's like a gravy train. It's not. It can stop very, very quickly. And if you haven't done the right things, what happens is you end up kicking yourself. And that's really, really unfortunate. Keisha. Hi, Pete. What are your thoughts on US inflation up slightly today? I haven't actually seen that, actually. Is it up slightly today? Right, let me go and have a look quickly. 1 second. Let me just have a look at this. Hopefully it would have updated. The thing is, they took measures, even though they were down at 3% the last time I looked, which was probably about a week or so ago. They took measures with their Fed rate. So they increased it by 0.25%, regardless of the fact that they're closer to our target than we are. So where are they right now? Let's have a look. Inflation. So their inflation rate right now is 3.2%. Let me just see if I can share this with you guys. 1 second. All right, so this is their inflation rate right now, 3.2%. They were at 3. But then again, they did take action. So hopefully, the reason why they increased their Fed rate was signposted or in anticipation of this happening. But it will be interesting to see whether we see this come out more consistently and whether we see inflation jump over the next few months and what they do about it, really. And this goes back to the point that you just cannot be, you can't be lax with this kind of stuff. And only time will tell. We'll be able to look back on this and say, should the Bank of England have put it from 5% to 5.5% opposed to 5.2? We'll know in a few months' time whether it was the right thing to do. But hopefully, we won't see the inflation number in the States tick up more than that. I haven't actually read any commentary on this today. This is the first that I've heard of it. So I'll have a look at that as well. Maybe have some commentary in a conversation maybe tomorrow or next week on this. But I would hope to think that they anticipated this was going to happen, which is why they pushed 0.25% a couple of weeks ago. This is the unwinnable equation, right? Either low interest rates, high house prices, or lower prices, high rates. In an ideal world, you'll be able to get them kind of like that. If you had low house prices, low interest rates, everybody wins. But you've just got this seesaw. To get them in equilibrium is it's so hard to do. Hi Pete, would a bank accept multiple valuations from different estate agents on the same figure, or would the bank send their own valuation agent to confirm the values I got from the estate agents? They will likely want to have one of theirs confirm it. And what they might do is if you have multiple, they'll probably just take an average of it. Basically, I mean, I just recently had a RIC survey on our house here, and what they do is they take a average of similar properties around you. The banks will definitely want to send out their own, though, for sure, and then they may consider the other evaluations. But it's likely they'll probably just take theirs, because at the end of the day, if you think about it from a lender's point of view, they want to make sure that they're covering all of the ground themselves, and they're not going to take the advice of a third party. They want to make sure that they get it right on their own, because they're taking the risk with the mortgage, essentially. Scott, is 40% deposit the lowest? Is 40% deposit the lowest the mortgage rate will the lower the mortgage rate and will go, and it doesn't seem to change after that when I look at comparisons. Yeah, so I think kind of alludes to what I was saying before. 50% is kind of where you get the best rates. Anything below that, nothing really changes beyond that, really, to be honest. So 50% loan to value tends to be the sweet spot where you get access to the lower rates, because the risk is lower for the lender. Adam West, I wonder if banks dropped mortgage rates, the government will apply less pressure on them to offer savers better rates. No, I don't think that's going to work, mate. I mean, if you think about it, we need people to save a little bit more. That's the whole point. You make saving, people not spending money, the urge to spend money, less attractive by offering higher savings rates. So they may have done this, but I don't think it will mean that the government doesn't put any further pressure on them to increase savings rates. All right, first time buyer currently going through the process with searches just arriving, 10% below asking, agreed already, but plan on asking for further reduction given base rate is getting higher. He's also saying here, good time to buy potentially, way better market than what we went through last year, climbing up to the top of each other. That's true. I mean, I think you asked the question on here before whether or not you should go and renegotiate that price, and I said, yeah, if you don't ask, you don't get at the end of the day. So you've got nothing to lose by saying, look, property prices have fallen quite a bit. Can we talk about this price and see if the seller budges? Anil, great things. Q&A session, useful as always, admirable. Thank you very much. Just before we conclude this, because there are no other comments in here. Yeah, let me just talk a little bit about something I've just done on Instagram. Now, obviously, we have the Q&As here on Sunday evenings. We have one on Sunday, hopefully. where you guys can ask a few questions. But oftentimes when I answer questions, I can't give you more than just a generic answer, because there is no way of me just being able to communicate with you to find out key facts, to be able to say, right, this is probably the right thing to do or something you should consider doing. And so on YouTube, there is now a subscription model on YouTube, where if you subscribe, you can DM me and we can have a conversation around your question. The main perk is you can ask me any question during your subscription period, and I'll come back to you within 24 hours. So there's a few people that have jumped on it over the past couple of days. I'm helping someone at the moment with exactly this, buying their first home. They got a deposit. They just want to know, right, what are the key things? So we're in discussion at the moment, going back and forth around his salary, so on and so forth. So I can actually ascertain, right, in terms of what you want to buy and your salary, yeah, you're going to be okay, or no, you're not going to be okay. These are the things to make sure that you do as your checkpoints, if you will. So the subscription just gives you access to me. Now, just to explain it, the subscription, it isn't, you're not locked in for like 12 months. You can cancel at any period of time. But currently for the first 25 people, you get a 50% lifetime discount, down from $9.99 to $4.99. So go and consider that if it's something that you'd be interested in. I don't expect a lot of people to jump onto this, but for those people who do need it, it could be really, really interesting. But that's over on Instagram, if you're interested. There's a few more comments that have gone in here. Spencer just saying, where's the hair gone, Pete? You've been spending. You know what, dude? Listen, I'm starting to lose my hair and I've got grades and everything coming through. So I've had to adjust to a new haircut, and I don't really like it. I prefer to have it long on top, but it's just not sustainable, to be honest. So turkey might be on the agenda. No. I'm not gonna go do a hair transplant in Turkey. But yeah, I just have to adapt, mate. Age is catching up and everything, you know. And please don't forget to like, people. Please don't. We've got 69, about 70 people on here at the moment. We've got 33 likes. If we can get up to 45, that will be amazing, which means we need about 12 more. I think that's doable. Much appreciated. Aaron's just saying here, my prediction is that those with large deposits in savings, 70, 80, 90K, will have more of a incentive to save than someone with a couple of thousand. What are your thoughts on that? Yes, 100%. For sure. I mean, the more money you have, then yes, you're now rubbing your hands thinking, oh my God, finally I can get, a savings account that is going to push my money a little bit further. That actually has a knock-on effect to, the markets and people wanting to invest, the sentiment to want to invest. Because if you can get a decent rate, a 5 or 6% return, and there's no risk involved, then why would you go and put it in the stock market that can be very, very volatile? It just opens up people's choices. And I think you're right as well. For people who have less money, or maybe only a couple of £1,000s, I don't think that the incentive is still the same, but the rewards are different. And I think that's where mindset and the way we think comes into it as well. Because we may think, oh, it's £2,000, it's not going to make any difference, but actually it does. And so that mindset shift and seeing the incentive for what it is and not the benefit necessarily is really important. And those two things are very hard to detach. You have an incentive to do something. So the automatic question is, what's the reward? And if you perceive it to be not worth it, you're not going to look at that incentive, right? And that's where, we talk about short-termism, not looking at that immediate gratification, thinking more longer term. It takes a mindset shift to a certain degree. I will say this as well, man, because, and let me just say this, because I think this is really, really important. With all the content that I make here on the channel, I always try and make sure that, we're not in the business of pointing fingers at people and saying you're bad and I've seen this too many times in my comment section over the past 2-3 weeks. People saying, well, if people don't know how to budget, it's therefore, if they get into debt, it's therefore, if they, I did the video on, was it on Monday or Tuesday, where we listened to the LBC question to Rishi Sunak, a guy called, I think his name was James, right? People were saying, well, he's over leveraged. And it's like, you don't know that. It's like, we need to have a little bit of empathy for other people's situations, not just jump to conclusions. Yeah, his mortgage is going to go from 1,500 to, what was it, 2,800 or something like that a month. but we have no idea what his personal circumstances are. He may have a kid, he may have a family and 4 kids where he actually needs a bigger house. We have no idea. Then you can ask the question, well, why should you have so many kids? Well, how long is a piece of string? How do you answer that question? And the comment section get a little toxic sometimes with people just being really judgmental. I think that kind of stuff is just completely uncalled for. And it just shows that as a society, sometimes we really are very, very intolerant and inconsiderate of other people's situations. It's like someone put a comment out there about, if you get into debt and you start using credit cards, it's your fault. And I'm like, it's all very well and good to say that from your place of relative comfort where you don't have credit cards and maybe you've never been in that situation. That's all very well and good to say that. But I'll put it like this. I was once homeless. And one of the things that I experienced a lot when I was sleeping on the streets were people, who would call me an alkie or a druggie. I've never done drugs in my life. And it's like, you don't know what got a person to a certain situation, but we make a snap judgment. And I don't understand why we do that. Yeah, like our own little perfect bubble exists, but there is something outside that perfect bubble or our bubble that we live in. And it's just a little bit of consideration and trying to understand where people come from. I talk about my own debt journey. I got into debt because I was on the streets. I couldn't feed myself. So my checkbook had to come out because I had a checkbook and I could go to Tesco's, fill up a shopping truck, bag, and walk out and bounce a check. That's how it all started for me. That it isn't because I had a drug addiction or I had an alcohol addiction. It wasn't because of any of that. And I feel as though we just need to be a little bit more tolerant and understanding of people's circumstances. Yes, some people make really bad decisions. But how do we know who makes a good decision or who is there because circumstances conspire against them? We have no idea. And I just don't like seeing it in my comment section. I delete most of them. And sometimes I'll call them out because I don't like people being dicks in my comment section, really. That's all I'm trying to say. So, if you do watch this and you follow the channel, I'm sure that you don't, but there'll be people who may come across a random video and just feel like, I'm just going to keyboard warrior it for a second. Like, stop and think. Don't be a dick. Just because you're rosy and you're fine, it'll be very, very easy for me to say, well, I've got no debt now. I've got a mortgage, which hopefully I pay off in 2 years' time. And be like, well, if you're in debt, you're an absolute scumbag and you're a brokey and you're dirt. You make really poor decisions, like sort yourself out. It would be very, very easy for me to do that. But that would be so hypocritical equally. It's like we don't know what gets people there. And I think, understanding and just being empathetic, not sympathetic. Empathetic is so important, really, really important. And Adam's just saying here, money is a tool. That's all it is at the end of the day. Some people learn how to use that tool more efficiently and earlier than others. I learned how to use it as a tool in my mid-30s. How freaking bad is that? This is why I do what I do now. So if I know what I knew now when I was 17, 18 years old, it would be so different. And I think 99% of people who watch this will agree with that and wish exactly the same. But it is a tool. And this is all about just trying to understand how all of it works. And more importantly, how to make decisions in the understanding of how it all works, with the acknowledgement that you're not going to get it right the entire time, because it's impossible. Unless you can jump into a time machine and go and get a sports almanac or something, you're going to make a mistake. And it's okay to make mistakes. It's fine as long as you're able to be resilient enough to fight your way back if it's a really, really bad mistake. In my instance, it took me 15 years to get out of debt at great detriment to my own mental health, to anxiety, depression, not sleeping well. I didn't know it at the time. I was writing my book when I was like, this was so messed up. But whilst I'm in it, I'm just going through, I'm in the trenches. I'm just going through it. I'm at a better place now, but there'll be millions of people in that exact same space right now who are looking for answers. And thank God for YouTube. Thank God for social media. Well, most of social media because there's some really bad information out there. But like this wasn't available in my day. YouTube, how to get out of debt. Are you kidding me? And I talk about this in my book as well, right? I talk about this in the book. Like you had to go to like Citizens Advice Bureau. Like, do you? Oh, mate, listen. Empathy is really, really important. Empathy is so important. Someone's just saying here, set several reminders before the end of a 2 or 5 year fixes, because people should be mindful about lapsing into standard variable rates currently. Mate, listen, I spoke about this the other week, and I think I showed one last week, which was like 8.49%. I mean, if there is one at night, can you imagine? Can you imagine? So I don't know what you would do. Imagine coming off a mortgage of 1.45% or 2%, and you go into a standard variable at 9.79. I need to, 1 second. Let me just see if I can actually just work this out very, very quickly. What difference would that actually make? So I'm going to use my old rate as a, or my current rate, I should say, as the example. 1.49%. Let's see what this kicks out. Oof. No, let's go full repayment as well. We don't want it on interest only. Let's go full repayment. Okay, there we are. And then let's go and do that on 9.75%. The difference will give you a freaking heart attack. I mean, can you imagine being faced with this? Right, here we go. I'm going to share my screen. 1 second. Have a look at this for a comparison, right? Let's have a look at the first option, which is this one right here. So again, using average house price, 10% deposit, 35-year term. Back in the day, if you were lucky enough to get it at 1.49%, which you probably wouldn't have done because of, you know, the loan to value, but hypothetically, £784 per month. This is what it would look like if you went from that deal to a standard variable rate deal of 9.79%. Look at this, £2,164. You would have a heart attack going on to that. And trust me, there are people, I spoke about mortgage prisoners last week, or was it this week, in one of the live streams recently. There'll be people who are going on to standard variables rate right now where they can't get stuck. And when I spoke about the mortgage charter, I said, and I said this on Sky News as well, I wish the government did something a little bit more for those. Because can you imagine seeing that kind of jump? What was it? £784 to 2,164 quid. You're selling your house. You're selling your house. You cannot sustain that kind of payment. It's insane. It really, really is. And I know that, you know, this is all negative and it doesn't really paint a great picture, but it gotta, mate. Thankfully, I'm not in that position. It's absolutely mad right now, and the banks really should be held accountable for people who go from a fixed rate to a standard variable rate where there's no transition. And yeah, people might have lost jobs, they can't prove income, but they've made the payments and they have a good history of making payments. They have to render some help. I'm just saying 100% agree. People are far too quick to make assumptions without knowing someone's personal circumstances. I'd agree with that. You should you should go to Turkey. Really? Mate, listen, add me on Instagram, mate, and let me know what your experience is. You know what? It's on the crown of my head. It's not really that bad. And, you know, yeah, I do like to have it long on top, but it's like, I don't know, man. I don't know, dude. The thing is, does it keep? Is it long-term results, or do you have to revisit this kind of stuff? I don't know, man. I think part of me is like, it's part of aging, so like just be cool with it. But at the same time, it is hard to take as well. It's like you start to think, well, actually, hang on a second. I was in my 20s like yesterday. Like, how is it now that I've got grades coming through and like I'm sitting on the crown of my head, like, and now I start looking at dudes with full heads of hair, like, you and your full head of hair, you have no idea. You know, it's the little things like that you never thought about before. They come to be very, very prominent at the forefront of your mind. It really, really is. Poverty, the need for survival usually overrides what is logical or ethical 100%. 100%. Like, and I talk about this in the book. When you are in survival mode, logical thinking goes out the window. You're not thinking logically, you're thinking base instinct, you're thinking survival. So, and people don't appreciate that. People really, really don't appreciate that. And I think that people don't appreciate it because they've never experienced it themselves, and they never allow themselves to think about what it might be like for people who are not in the same position as them. I've luckily gone through the entire curve of it all, from, you know, even when I was in Nigeria, to having no electric, no water a lot of the time, to coming back, being happy to being back, then being on the streets, and then realizing, well, actually, I'm on the streets. It's not paved with gold. My expectations have kind of been, I guess, weren't necessarily realistic at that time, but I knew I had opportunity. And that was and I talk about this in the book. And again, if you've not got the book, it's not just the finance book. I share a lot of my story in there, and how I've come to, how the formula comes together, because everything in the basic formula. So the basic formula is an acronym. Basic is, you know, B, budget; A, avoid debt; S, save early; I, invest early; C, credit cards. All of that I've had to learn on my own through trial and error, through my own, and I interweave a lot of my personal story into it as well. And I think whenever you talk about money like this, you have to make it relatable. You have to kind of let people know that actually, if you're in a particular situation, like a lot of people are there, and I'll happily stand up in a room. I'll happily stand on a pulpit and be like, listen, I'm the first one who messed everything up, but I've done okay. If I can do it, so can you. And I think that's really, really important. Oh, cheers, mate. I've just bought your book. You sound like a great guy. Keep up the good work. Thank you, guy. Really do appreciate it. Thank you very, very much. And look, I've always said this. You know, I do travel quite a bit for work and stuff. And people are asking me, maybe do book signings and meetups and stuff like that. Book signings are very, very difficult to organize, but meetups are easier. And what I will say is, if as I think about my next traveling scenario, because I don't know what my TV commitments are going to be. I'm doing a TV show next week, or at least I'm filming a TV show next week. I don't know what my commitments are for Channel 4 until the show comes back. So depending on where I am in traveling, I will probably do more meetups. And if I do a meetup in your local area, Guy, bring the book along with you, because I will sign it. And if anybody wants a signed copy of the book, because you can get it on Amazon, but obviously it's not signed. If you do want a signed copy of the book, I do have some in the house. So let me know. Just message me on Instagram, and we can organize for me to do a signed copy and send that out. But I hope you enjoy the book. I am going to be doing a book club as well. I'm getting some stuff organized in the background, just in terms of infrastructure, to make it really, really seamless. But the idea with the book club is that we'll go through the book, and I'll take you through the exercises in the book, because it is a practical book as well. And each week there will be things that you need to do. But by the end of it, you would have successfully ticked off every single area of the basic formula, to ensure that you're in a really, really solid place after the book club periods. It might be 6-8 weeks maybe, and I run it in cohorts of maybe 20 or 30 people, and I might do one a quarter. But the idea is, you would read the book, we'll go through the book together. More importantly, we'll make sure that you actually do the practical elements of the book. So it's not just a book that you read and be like, yeah, that was good, pop it aside, but nothing's been implemented. Accountability is really, really important. We can start to build a community of people as well around accountability for things going into the book, and questions. And, you know, there's lots of stuff we can do, lots of ideas that I've got, but that's something I'm going to be doing shortly. So if you're interested in that, message me on Instagram, and I'll put your name down on a list. There will be a website soon, a landing page that I'm going to build, where you can just register your interest, but it's not up and running just yet. So message me on Instagram for the time being. And I'm just saying, mate, listen, I wish I was 35, but I'm not. I'm not. You can almost add a 10 years and take off 2. I'm going to be 44 in November, actually. So I don't know where the time went, my friend. I really, really don't. I'm just saying here, try hair building fibers. I've done that. They did work, but at the same time, it gets a little bit messy and stuff like that. But I have tried it, and now I'm kind of like, you know what? Let me try the low fade a little bit, try and get used to that. But If it doesn't work, then I'll probably just go back to having it long. Then you can do the hair fibers in the top. It's not really that bad, but obviously when it's happening, you're conscious of it, and I'm really, really conscious of it. So yeah. Oh, did you? Oh, very, very nice. Incredible. See, this is amazing because, like, obviously, I do a lot of stuff, and I have no idea who reads stuff, who picks things up. So this is really, really nice to actually know. Thanks for that. And yeah, the first time buyer magazine cover was earlier this year. Was around about when the book came out. I think it was like Feb or March, maybe April, roughly. I still got a copy in the house. It was very, very weird because people would like message me on Instagram and be like, "Oh, I just saw you on a shelf," and I'm like, "What do you mean?" And it's like, in this magazine. I was like, I completely forgot I'd done it. So it's really nice to know that you actually picked up the magazine. So thank you. All right, guys, I am really conscious of time. We're 56 minutes in. Thank you so much for joining. If we can get the likes up to 45, 7 more, that will be amazing. I'll probably do another live tomorrow evening, which will be Friday. We'll take a break on Saturday. Then we'll do the finance clinic on Sunday evening, probably from about 7 o'clock. But if you've not subscribed and you've not hit the notification bell, if you do that, you will get notified when I actually schedule lives like this. I try to keep all of these as conversation as possible. Yes, I monologue for a little bit of it because I want to be able to share some knowledge. But more importantly, I want it to be a two-way thing where I bring in some of your comments as well and try and normalize a conversation of money. The channel used to be called Conversation of Money. My business is called Conversation of Money. It's normalizing it, making it normal for us to talk about money in this manner. And I am very much enjoying doing the live sessions. But thank you so much for all of your support and being part of the community. Again, if you do have any questions, consider subscribing on Instagram. And yeah, I will speak to you guys tomorrow. Enjoy the outro.
Yeah, surprise, a little different than you used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coke. While I'm researching these stocks, buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming for his vote.